How UK business owners are legally reducing their tax bill using trademarks and intellectual property. So if you own a UK business, whether that's a limited company, a group of companies, an e-commerce brand, professional services firm, and you are paying corporation tax at 25%, I want to ask you a very important question. Who owns your brand? Not who runs it, not who built it, but who actually legally owns it. See, most UK business owners don't know this, and frankly, most accountants aren't telling them either. Your trademark, your brand name, your logo, your slogans, your intellectual property, these assets have enormous value. And right now, if your UK company owns them, HMRC is taxing you on every penny that value generates. But then there is a completely legal, HMRC recognized, internationally accepted structure that allows a separate company based in the UAE to own those assets and charge your UK company for using them. That charge is called a royalty, and that is fully tax deductible in the UK. So in plain English, instead of your company making £500,000 profit and paying 25% corporation tax on all of it, your UK company could be paying a royalty and marketing fee back to a UAE entity, reducing that taxable profit significantly and completely legally. My name is Huzaifa Vuraji and I'm the founder of Evolve Tax, and we specialize in helping UK business owners restructure their intellectual property, their brand assets in the most tax efficient way, fully compliant with HMRC using proven international frameworks. Today I'm going to walk you through everything: what trademarks are, why they matter from a tax perspective, how the UAE structure looks and it works, what HMRC looks for, the documentation that you'll need, and why this is complex, and why people are getting it wrong, and if you do get it wrong, how it can be catastrophic. Let's get into it. What is a trademark and why it matters? A trademark is a legally registered intellectual property right. It protects your brand identity, your business name, your logo, your product names, your slogans, anything that distinguishes your goods and services from a competitor. When you register a trademark, whether you register it in the UK, the EU, or internationally, you are creating a legal asset, not just a right, an asset, something with genuine, measurable economic value. Here's where it gets interesting from a tax perspective. So if a business owns a valuable asset, it can charge other parties for using that asset. Think about how McDonald's works. McDonald's Corporation doesn't technically operate most of its restaurants. Its franchises do. And those franchises pay McDonald's royalties and fees for the right to use the brand in the systems. Now, you might not be McDonald's, but the same principle applies to your business, even at a smaller scale. So if your UK trading company uses a brand, a name, a logo, a website, a set of marketing materials that is owned by a separate entity, that entity can charge your UK company for usage. So that charge, the royalty, is a legitimate business expense. And in the UK, legitimate business expenses reduces your corporation tax bill. This isn't some kind of loophole. This is not a grey area. This is internationally recognized, OECD compliant, and used by thousands of businesses globally. From the largest multinationals to UK SMEs with £500,000 turnover, the question isn't whether it works. The question is whether you're doing it correctly. And that's where most people fall down. So big brands that already do this include the likes of, Nike, Nando's, anyone that you can think of. So let's just show this isn't theoretical and it's practical. The world's most successful brands have been doing this for decades, legally and openly, with HMRC fully aware. Nando's, Nike, Starbucks. Nando's originated in South Africa, but operates globally, including hundreds of restaurants in the UK. The UK restaurants you walk into aren't just paying full UK tax on every pound of profit. Nando centralizes intellectual property, the brand, the recipes, the systems, in a completely separate entity. So the UK operating companies pay for the right to use that brand and those systems. Now those systems are tax deductible. The expense when they pay for these payments, are deductible expenses in the UK. Nike is probably one of the most famous examples of IP-based tax structuring. For years, Nike held the intellectual property for much of its non-US business through entities in low tax jurisdictions. UK operating companies paid royalties for using the IP, and those royalties were deductible. The income just went to a lower tax jurisdiction. The structure was OECD compliant. It was documented and fully transparent. Starbucks, for example, in the UK faced public scrutiny, I think it was 2012, for paying very little UK corporation tax. How? Through royalty payments. So Starbucks UK paid royalties to a Starbucks entity in the Netherlands for the right to use the brand and systems, 6% of their revenue. And HMRC obviously didn't find this illegal, but it was about public optics. The royalty mechanism itself was legitimate. The takeaway that this is standard international tax planning. So Nando's, Nike, Starbucks, Apple, Google, Amazon, all of them use this framework. The principle is the same for your business. The difference is scale and proper documentation. So why do we recommend the UAE? You know, the other companies or bigger organizations are doing it in Netherlands, etc. So why do we recommend the UAE? So the concept is simple. You have a separate entity that owns the IP, charges the UK company, but the UAE has one of the most business-friendly tax environments in the world. So UAE free zones and an entity in the UAE will qualify for corporation tax in 0 to 9%. And that's the amount corporation tax. And that's even after you still get a buffer of 375,000 dirhams profit before you start paying any corporation tax. And if you move quite quickly with this, if by December 2026 your turnover is less than 3 million dirhams, then you get small business relief and you pay no corporation tax on all of it. But the way the vehicle and the mechanics work is that the UK company pays a royalty to your UAE entity. That royalty is deductible in the UK. The royalty income then is received in the UAE, and you've moved from an environment of paying 25% corporation tax to 0 to 9% corporation tax, or maybe even just none at all. And the UK and the UAE double tax treaty protects the flow of the royalties, and it reduces or eliminates the need of withholding tax. So this combination, UK deductibility, UAE low tax, double tax treaty, is why the UAE is the jurisdiction of choice. But this only works with the right setup. And as easy as it sounds, the setup is complex. So how does the structure actually work? So initially, you'd have to set up a company in the UAE, register it with a bank account with legal substance. Then you have to register or assign your trademarks and IP to the UAE entity so that it becomes the owner of the asset and it legally owns your brand. Then you'd have to create agreement between the UK company and the UAE company, or the UAE company and the UK company. The one thing before you can create these intercompany IP licensing agreements is to have to do a transfer pricing and a benchmark study. But this is something that we will do for you. So then once you've got these intercompany agreements, this legally contracts the UAE entity to license the intellectual property back to a UK company. It sets the royalty rate, the marketing fees, the scope, and the duration of this contract. The next thing is the UK company makes royalties and marketing payments for the UAE entity. Typically, royalty rates are from 3 to 8% of UK turnover, and marketing fees are between 5 and 12% of UK turnover, so not profit, turnover. So a real life example is if a UK company has turnover £2 million with a profit of £600,000 and you are charging 5% royalty and 7% marketing fee. So that would mean that you'd be in essence be able to charge the UK company £240,000 and that's tax deductible. So then your taxable profit goes from 600k down to 360k, and then your tax liability drops from 150k to 90k. So you're saving legally £60,000 in tax. Now, what does HMRC actually look for in these scenarios? Let's look at the arm's length principle. Would independent parties agree to this rate? Benchmarking that is essential. So we help with doing that. And we keep all the documentation, so if HMRC were to ever to ask, we can provide our proof. Real substance, the UAE entity has to have an office, staff management, bank account. It's not just a shell company. So we would help you with that, have a general manager appointed for you, give you a service based on that, so that every box from HMRC is ticked. And then legally robust agreements. Contracts must cover the scope, the fees, deliverables, duration, governing law. Transfer pricing study. So it's a report that documents the methodology, the market comparables, and comes to a conclusion that this is a fair amount to charge. Then you've got control foreign company rules. So we have to be compliant with the HMRC control foreign entity rules. Genuine UAE activity avoids the UK control foreign company attribution and the fact that you have a general manager here that's making the day-to-day decisions of this business. Now, in terms of withholding tax and treaty relief, correct application of UK-UAE treaty to ensure that it's compliant. If you work with Evolve Tax, what we do is we provide documentation packs. So we keep all of this in our systems and give a copy to yourself as well. So it includes things like, we'll register the trademark for you. So we'll do that for you, including in our service. We will send you a transfer pricing study and a benchmarking report. And that transfer pricing study and benchmarking report demonstrates arm's length rates. We'll prepare and send over intercompany agreements, so bespoke IP licensing and marketing contracts, a substance evidence file, so that shows UAE office lease, staff contracts, bank activity, withholding tax clearance pack, so the treaty certificate notifying HMRC, writing to HMRC, CFC or CFE compliance file, so it proves UAE economic activity. And then we do an annual compliance checklist, so we review the rates, we do treaty certificates and documentation annually. So what is the actual evolved tax roadmap and how can you take advantage of this? So initially we'd have a consultation and we'll assess your needs. Then we'd send you a proposal and you'd engage with us. We'd onboard you. We'd start by doing the UAE company setup. So we'd form the company for you, ensure the correct setup with the substance. Then we draft and execute. Even before that, we'd then decide what classes that you need for your trademark, register your trademark using this UAE company. We'd then draft and execute intercompany agreements. And that would be based on our transfer pricing study and our benchmarking report. We'd implement the general manager service. We do the tax treaty clearance and CFC compliance with the UK, with HMRC. And we do an annual compliance calendar setup to review this on a yearly basis. Obviously, with laws that change within the UAE or the UK, we do ongoing monitoring and annual reviews or monthly reviews, quarterly reviews. So why is this actually complex? The reasons why it's complex is because of the UK transfer pricing, the control foreign company or control foreign entity rules, the UK-UAE treaty, the UAE rules in terms of company set up with FTA, taxation, compliance, HMRC's anti-avoidance provisions. That is quite complex. What are the common mistakes people make? So people have come to us and they've had the wrong royalty rate. They haven't had no substance proof. They are backdating agreements. They're ignoring the withholding tax. They're treating it as just a one-off. In order to avoid these kind of mistakes, you need to be able to engage specialist tax advisors, transfer pricing experts, legal professionals, UAE substance specialists, and we have all of that in-house. And this is literally what we do on a day-to-day basis. So what is it in terms of real world numbers? So let's just say you had business A. If that had a turnover of £1 million, in terms of corporation tax, you're probably saving about £32,500 annually minimum. If you had £3 million turnover, business B, let's just say, that would save £90,000 annually. If you look at business C with 5 million, you're saving 125,000 annually. So over a course of 5 years, that's £625,000. And all of them rates are within HMRC benchmarks. They're being conservative. So who is this actually for? It's for UK limited companies that have a turnover, I'd say, minimum £250,000 upwards. You've got a recognisable brand with logo, name, services or products. You're a UK resident owner prepared to set up in a genuine presence in the UAE, or you're a UAE resident already. The industries where brand drives value is like e-commerce, services, retail, hospitality, tech, media. This isn't suitable for your low turnover, low profit businesses because the cost outweigh the savings. So if you've watched this so far and you're serious, and you should be serious about this because this is serious money we could save you, go to our website, www.evolvetax.co.uk, book a call, a no obligation strategy call. We'd find out what about your business. We'll find out how we can help you. And if we can help you, we'll send you a proposal. When you come to our consultation, come with your turnover, your profit, know what your IP assets are, know website, trademark, whether you've trademarked it, whatever. Give us as much information as possible. Ask questions, challenge it, understand it. You'll definitely have some reservations. Sometimes things are too good to be true. And my motto in life is something's too good to be true. You have to look into it before you make a decision. But we'll help you come to your right conclusion in your decision, something that you're comfortable with. Every week we speak to loads of people. And every week, without this, your company pays 25% on profits. It doesn't have to. We can change that. At Evolve Tax, we do intelligent structuring, proper compliance, and it's real results. So book your call today.